Welcome back to my channel. It's always great to have you here. If you're like me, you've probably felt it too, that subtle shift beneath the surface. Headlines are loud, the numbers are jarring, but it's the patterns behind them that whisper the truth. We're living through one of those moments where history doesn't just rhyme, it begins to repeat louder, more insistently. And when you understand that life, like economies and empires, moves in cycles, you stop being surprised. You start seeing the signals for what they are, the echoes of past mistakes, the warnings of future consequence. Let's take a breath and step back together. Right now, the world is watching as the U.S. imposes economic sanctions, wielding the dollar not just as a currency, but as a weapon. This isn't new. Economic warfare has long been the soft edge of hard power. But each time it happens, it reshapes trust in the global financial system. And trust, once bent, rarely snaps back into place. Other nations are responding. India is striking direct deals with Russia, sidestepping the dollar altogether. Countries that hold dollar-denominated assets are beginning to question whether they want to hold those assets at all, especially if there's even a whisper that they could be frozen, seized, or sanctioned. This isn't about ideology. It's about incentives. And incentives shape behavior, always have, always will. What's happening today in real time is part of a much larger story. A story I began to understand only by looking back. In 1971, I was clerking on the floor of the New York Stock Exchange. That's when President Nixon came on television and calmly declared that the U.S. would no longer honor the dollar's convertibility into gold. That announcement, though, dressed in statesmanlike rhetoric, was nothing short of a monetary revolution. In that moment, the rules of the game changed. The dollar, once a promise backed by gold, became just a promise. And here's the kicker. I expected markets to crash. I thought removing the gold anchor would destroy confidence. But the stock market soared. Why? Because I misunderstood the mechanics. I hadn't yet learned that when you devalue a currency, asset prices, those denominated in that currency, tend to rise, at least nominally, not because the companies became more valuable, but because the measuring stick money had just shrunk. That day changed my life, not because of the price movements, but because it revealed how little I understood about money, credit, and the hidden forces that move markets. It sent me into the past to understand how often these surprises had occurred before. And what I found was remarkable. Nearly the same playbook had been used in 1933 under Roosevelt, with nearly identical effects. Devalue, inflate, stimulate, confuse. Ever since, I've made it a point to look for the patterns behind the events. Because if you can understand the recurring mechanics of debt, inflation, political conflict, and empire, you can prepare for the future, even if you can't predict the precise headlines. Today, we're watching another currency regime begin to shift, not in a flash, but in a series of steps. You might miss it if you only look at the news. But underneath it all, something deeper is at work, a questioning of the very nature of money, of what it means to store value, of what you can trust when promises start to wobble. In this series, we'll look at the mechanics driving this moment. We'll explore the 5 kinds of war every great power faces. We'll examine why debt keeps growing faster than income, why inflation persists even when growth slows, and why central banks around the world are caught between tightening too much and not enough. We'll talk about capital markets, interest rates, equity valuations, and also about trust, productivity, internal cohesion, and the kind of conflict that doesn't start with bombs, but with beliefs. This isn't about fear, it's about clarity. If you've studied the rise and fall of empires, the booms and busts of markets, the psychology of money, you start to see that we've been here before, just in different clothes. So let's begin not with panic, but with perspective. Because understanding where we are requires first seeing where we've been and how we got here. Let's dive deeper into the story. If there's one thing markets punish more than bad news, it's being unprepared for it. The irony is, most surprises aren't new. They're old mechanics dressed in new narratives. Let's go back to the 15th of August, 1971. President Richard Nixon appeared on national television to announce a bold move. The United States would temporarily suspend the dollar's convertibility into gold. That temporary suspension became permanent. With a few words, the global financial system previously grounded in the Bretton Woods gold standard was fundamentally altered. No more gold backing, just fiat, trust. At the time, I was a young man working on the floor of the New York Stock Exchange. I assumed this kind of monetary upheaval would crash the markets. After all, wasn't the whole idea of money based on confidence? And wouldn't that confidence collapse once people realized the dollar was no longer tied to anything tangible? But the market didn't collapse, it soared. That moment changed how I thought about cause and effect. It taught me that price action doesn't follow intuition, it follows liquidity. When currencies are devalued, nominal asset prices often rise, not because businesses are more productive, but because more money is chasing the same amount of goods and equity. What I witnessed was the early chapter of a much bigger story, the transition from hard money to soft money, from discipline to discretion, from a gold-linked world to one governed by printing presses and policymaker psychology. And when I studied further, I realized 1971 wasn't the first time. It was a rhyme. Back in 1933, in the depths of the Great Depression, President Franklin D. Roosevelt issued Executive Order 6102. It required all Americans to turn in their gold. The government then revalued gold from $20.67 an ounce to $35, effectively a 69% devaluation of the dollar. Just like that, wealth shifted from citizens to the state, from savings to stimulus. 2 different decades, 2 different crises, but the same playbook. When debt burdens become unbearable and growth stalls, policymakers are faced with a choice: default in hard money or devalue in soft money. Again and again throughout history, they choose the latter. Why? Because it's politically easier. Quiet inflation feels gentler than loud austerity. It masks the pain until it doesn't. We're seeing this logic emerge once more. The U.S., like many advanced economies, is running substantial deficits. Spending far exceeds tax revenues. Defense budgets, entitlement programs, environmental transitions, these are all expensive initiatives layered atop an already heavy debt load. And the cost of servicing that debt is growing as interest rates rise. So what happens next? History says either you raise taxes sharply, risking political revolt, cut spending significantly, triggering contraction, or you print money to cover the gap. The latter is often the path of least resistance. It's also the one most likely to erode the value of money itself. That brings us to a central insight, perhaps the most important of all. The value of money is not fixed. It's not just what's printed on the bill. It's what it can buy. And that value, its purchasing power, can quietly slip away when too much money chases too few goods, or when the trust underpinning the system begins to erode. When people realize that, they act. They shift their portfolios. They question their savings. They move out of currencies and into things. Real assets, inflation hedges, alternative stores of value. That's why what happened in 1933 and 1971 is so relevant today. These weren't isolated incidents. They were signals. They were warnings of a system under stress, of a cycle approaching its tipping point. Most people don't notice these changes until they feel them in the grocery store, in rent, in the slow fading of their savings. But if you study the machine, the flows of money and credit, the behaviors of governments and investors, you can begin to see them earlier. You can prepare not by timing the market, but by understanding its plumbing. We're entering a world where money itself, what it means, what it's worth, is up for debate. It's not just a unit of exchange. It's a store of wealth, a marker of trust, a reflection of policy. And when that trust is bent, or worse, broken, people react. That's why this isn't just a story about gold or fiat. It's about what happens when promises meet reality, when nations overextend, when debt demands resolution, and when the silent machinery of the financial system starts to creak under its own weight. We've seen it before, and if history is any guide, we'll see it again. The question now is, which part of the cycle are we in? If you study the rise and fall of great powers, you'll notice that conflict doesn't always arrive with tanks or missiles. More often, it starts with something subtler, a shift in incentives. And when incentives change, behaviors follow. When behaviors compound, systems shift. That's how empires rise, and that's how they decline. We are in the early stages of that process now. Today, the United States is facing simultaneous challenges on multiple fronts, not just economically, but geopolitically. There are 5 types of war that tend to precede the fall of a dominant power: a trade war, a technology war, a geopolitical influence war, a capital war, and finally, a military war. The first 4 are already underway. Take trade. Global supply chains that once prized efficiency are now being rerouted in the name of security and resilience. Countries are choosing redundancy over dependence. This is not just about semiconductors or rare earth minerals. It's about control over energy, over food, over strategic resources. And when countries feel vulnerable, they act to reduce that vulnerability. It's rational. It's also inflationary. Then there's the technology war. Nations are racing to out-innovate one another, not just for profit, but for power. Who controls the future of AI, quantum computing, or biotech will likely influence the future balance of global influence. It's no longer about comparative advantage, it's about survival. Next is the war of influence. Here, currencies play a leading role. For decades, the US dollar has been the dominant reserve currency, the lifeblood of global trade. But in weaponizing the dollar through sanctions, asset freezes, and restrictions on dollar-based systems, the US has introduced a new calculation into the minds of foreign governments. What happens if we're next? We're already seeing that response unfold. India and Russia now trade outside the dollar system. China is accelerating its push for the digital yuan. Countries in the Middle East are reconsidering long-standing oil pricing conventions. Central banks, particularly in emerging markets, are buying gold at the fastest pace in decades. These are not symbolic moves. These are shifts in trust, and trust is the foundation of any currency system. Now, we are entering the capital war. This is where sanctions are aimed not just at people, but at flows of money, freezing assets, cutting off financial systems, blocking access to SWIFT or the US banking network. On paper, these are non-violent tools, but their effects are often just as destabilizing. And history shows that capital wars tend to accelerate the unraveling of monetary empires. The final step is military war. And while we are not there with China, the situation with Russia and Ukraine has become a kind of proxy battleground. Western nations are funding, arming, and supplying one side. Russia is retaliating not just on the ground, but in energy markets and through alignment with China and other powers disillusioned with U.S. hegemony. Each step along this ladder creates pressure to self-isolate. When trust between nations breaks down, globalization reverses. Each country starts to focus inward on self-sufficiency, on energy independence, on strategic autonomy. The world fragments. Collaboration diminishes. That too is inflationary. In this kind of environment, traditional economic relationships begin to fray. Countries hold fewer of each other's assets. Trade agreements become weapons of leverage. And perhaps most importantly, money itself changes meaning. The dollar, once seen as a neutral store of value, is now increasingly viewed as a tool of policy, even of punishment. And that realization leads many to search for alternatives, whether it's gold, digital currencies, or regional barter systems. As more countries step outside the traditional financial infrastructure, the gravitational pull of the dollar weakens. And that brings us to a key insight. Money is power, but only when others agree to treat it that way. When confidence wanes, money becomes just paper or code or pixels on a screen. It needs consensus to have value. This is why the capital war is so critical. It strikes at the heart of that consensus. The implications for investors are profound. When you're in a world where trust in fiat systems is declining and inflationary forces are rising, the playbook changes. You no longer want to hold claims on future dollars because you're not sure what those dollars will buy. Bonds, which are just contracts to receive future money, become less attractive. So does cash. So do fixed income investments that fail to outpace inflation. Instead, money moves into things, real assets, productive enterprises, commodities, land, intellectual property, technologies that solve real problems. These are the things that survive when money itself is under question. And yet, despite all this, most people still think linearly. They extrapolate the recent past forward, assuming that tomorrow will be like yesterday. But history reminds us that change happens slowly, then all at once. We are somewhere in between. The 5 types of war are not just theoretical, they are active forces shaping behavior, markets, and outcomes right now. And as each intensifies, it reshapes the rules of the game, how capital moves, how assets are valued, and how power is exercised. If you're not watching for that shift, you're already behind. Most people grow up assuming the world they've inherited is the way the world works. But often, it's just one phase in a longer cycle, a paradigm that feels permanent until the ground begins to shift. For the past 4 decades, we've lived in a world of falling interest rates. That environment shaped everything. When borrowing got cheaper, asset prices rose, government debt was manageable, businesses could expand with leverage, consumers could spend beyond their means. It rewarded risk-taking, speculation, and confidence in the future. But what happens when that trend reverses? We're finding out now. What we're witnessing is the beginning of a paradigm shift, something deeper than a market correction and more fundamental than just a policy pivot. This is the turning of a long-term cycle. And once it begins, it tends to feed on itself. Here's how it works. For years, investors have been conditioned to believe that bonds are safe, that inflation is low and stable, that central banks can always step in to smooth over volatility. But when inflation becomes persistent, when it is not caused by demand surges, but by structural factors like supply chain shifts, wage pressures, and geopolitical fragmentation, then that assumption collapses. So central banks raise interest rates. But the problem is this: the higher those rates go, the more fragile everything built on low rates becomes. That includes real estate, tech valuations, corporate debt, and sovereign balance sheets. So the central bank is forced into a dilemma: fight inflation aggressively and risk breaking the system, or back off and risk letting inflation get entrenched. That's not just a policy problem. It's a systemic contradiction. Look at the United States. The government must fund not only social programs and aging demographics, but also military spending, climate transitions, and debt service. And that's just the baseline. Add in a slowing economy, and deficits balloon even further. So the Treasury must issue more debt. But as more debt is issued, buyers demand higher yields. And if yields rise too much, markets begin to wobble, stocks correct, housing slows, businesses cut investment. At some point, the pain grows politically unbearable. This is when central banks often return to the market not to raise rates, but to cap them, to buy the bonds no one else wants, to provide artificial demand for what has become a structurally unattractive asset. And when they do that, they don't do it with tax revenue, they do it with printed money. This is the soft default, the silent admission that debts will not be paid back in full, but rather in devalued currency. It's a cycle as old as empire. As the cost of money rises, behaviors shift. Companies cut back. Consumers hesitate. Investors reprice. But so do governments. They look for ways to ease the pressure. And the easiest way, historically, predictably, is to monetize the debt. But this creates a feedback loop. Higher rates make debt harder to sustain. So central banks intervene. Their interventions create more liquidity, which pushes up prices, particularly of essentials like food, energy, and so inflation persists. And then we're back at the beginning. This is the classic setup for stagflation, stagnant growth with rising prices. We've been here before. In the 1,970 seconds, a similar dynamic played out. Inflation surged, interest rates spiked, and the Federal Reserve struggled to regain credibility. It wasn't until Paul Volcker raised rates to near 20% that the inflation was truly broken, and that came at the cost of a deep recession and significant market pain. Today, we are nowhere near those levels of monetary discipline. In fact, the structure of our debt makes such discipline nearly impossible without sparking a financial crisis. That's why the most likely outcome, in my view, is a muddling through, a prolonged period where inflation remains higher than target, growth remains weaker than desired, and central banks struggle to regain control without triggering a collapse. This paradigm shift will feel unfamiliar to many investors. That's because most portfolios have been built in an era when falling rates lifted all boats. Bonds provided ballast. Stocks soared on liquidity. Real estate boomed. Even cash, though derided, was stable in value. But that world is fading. In a rising rate, inflation-prone environment, the correlations that once provided safety can reverse. Bonds and stocks may fall together, cash loses purchasing power, and those relying on yesterday's models may find themselves exposed to a very different set of risks. It's not just a shift in numbers, it's a shift in psychology. When inflation expectations rise, people behave differently. They spend sooner, they ask for higher wages, they hold less cash, they shorten duration, and those behaviors themselves become inflationary. That's the reinforcing loop of a paradigm shift. Perception changes behavior, which changes outcomes, which changes perception again. So where does that leave us? It leaves us in a world where assumptions must be re-examined, where long-duration assets require higher risk premia, where diversification means more than just stocks and bonds, and where investors must ask not just what returns they seek, but what environment those returns will be measured in. Because in a world where the value of money is changing, everything else must be reevaluated too. Every investment is an exchange, a trade, between something you have now and something you hope to receive in the future. You give up liquidity today in exchange for a stream of cash flows tomorrow. That simple idea sits at the heart of every portfolio, pension plan, and savings account. But here's the catch. When the value of money is uncertain, how do you price the future? That's the question we're all being forced to answer now. The cost of money interest rates isn't just a technical policy tool. It's the gravitational force of the entire financial system. It determines how much we value future earnings, how we discount long-term promises, and how capital is allocated across time. When rates are low, almost anything seems worth buying. Cash feels like a burden. Long duration assets like tech stocks or real estate look attractive because the future seems inexpensive. You're willing to wait because the penalty for waiting is small. But when rates rise, that logic breaks. Higher interest rates make future cash flows less valuable in today's terms. The math of discounted cash flow is unforgiving. A business expected to earn $1 billion 10 years from now is worth a lot less when you discount it at 5% than at 1%. That's not theory. That's what's driving much of the compression in asset prices today. But it goes deeper than that. Think about the relationship between cash, bonds, and equities as a curve, what economists call the yield curve. When rates were low, cash paid nothing, bonds paid a little, and equities were supposed to pay more. That structure created a natural incentive to move out on the risk curve. Why hold cash when bonds pay more? Why hold bonds when stocks could return even more? That's how capital flowed for years. But now the curve is inverting. In many cases, short-term cash is paying more than long-term bonds. Equities, once the obvious choice for return seekers, now offer only modest risk premia above cash, especially once you adjust for inflation. That raises a hard question. Why take risk at all? For many investors, the answer is habit. They've been taught that over time, equities outperform. And over long cycles, that's been true. But it depends heavily on where you start, on valuation, on inflation, on policy. When rates rise and inflation is sticky, equity multiples tend to compress. Growth slows, margins shrink, and the present value of future earnings declines. The path becomes bumpier, the payoff more uncertain. So what should we do? First, recognize that we're not just facing volatility, we're facing a repricing of the future. That means we need to think in real terms, not just what nominal returns look like, but what they buy. In a 5% inflation world, a 3% bond yield is a negative return. Cash, even if safe, loses value quietly every day. Second, rethink diversification. In the old paradigm, diversification meant owning both stocks and bonds. But in a world of correlated inflation risk, that may not be enough. You need assets that behave differently, those linked to real economic value. Energy, commodities, infrastructure, inflation, protected securities, even parts of private credit and real estate. You need exposure across geographies, currencies, and regimes. Third, understand the opportunity cost of holding debt-based instruments. Bonds are just contracts. They promise future payments denominated in currencies that are being debased. In a debt-heavy world with structural inflation, that promise becomes less reliable. Fourth, evaluate equities not as abstractions, but as claims on real production. Which companies can maintain pricing power? Which can pass through costs? Which are tied to essentials rather than luxuries? Which are located in jurisdictions that are politically and fiscally stable? Because the nature of risk is shifting. It's no longer just about volatility or earnings misses. It's about the stability of money itself, about the reliability of institutions, about the credibility of fiscal and monetary authorities. These are macro risk, system-level concerns that don't show up in quarterly earnings reports, but determine the backdrop against which all investing happens. And here's something most people miss. The real decision isn't between stocks and bonds, it's between owning claims on money versus owning claims on things. The further we go into a paradigm where money is losing its value, the more attractive real assets become, not just gold or commodities, but productive enterprises, intellectual property, land, technology, and innovation. That doesn't mean abandoning financial assets. It means recalibrating your expectations. If you think cash will hold its value, you might be surprised. If you think bonds will save you in a crisis, look at what happens when inflation is the crisis. The final lesson is this: the cost of money affects everything. When money was cheap and abundant, we overpaid for the future. Now, as money becomes scarcer and more expensive, we're being forced to revalue everything, including our assumptions. That process isn't over. It's just beginning. Markets move with numbers. Societies move with stories. Behind every economic system is a set of beliefs about fairness, opportunity, value, and trust. When those beliefs begin to fracture, the consequences go far beyond GDP. They touch the foundations of order itself. We are entering a period where internal cohesion is breaking down. Throughout history, empires have fallen not just because of external threats, but because of internal disunity. And often, the cracks start with inequality, not just of income, but of opportunity. Over time, the rewards of growth tend to concentrate. In the aftermath of major wars or resets like post-World War II America, prosperity tends to be more evenly distributed. The middle class expands, institutions gain trust. There's a sense of shared purpose. But as cycles progress, success compounds at the top. The wealthy accumulate more assets, they send their children to better schools, they gain greater influence in policy, in media, in markets. Meanwhile, the lower and middle classes face stagnating real wages, rising costs, and diminishing access to upward mobility. The gap widens not just in wealth, but in belief in the system. And when that belief erodes, something more dangerous begins to take root: polarization. Moderates vanish from the conversation. What remains are the extremes, populists on both the left and the right, each claiming to fight for the people, each unwilling to compromise. Dialogue breaks down. Institutions are distrusted, the media becomes fragmented, truth itself becomes tribal. This is not unique to our time. It's the arc of many collapsing orders. During the French Revolution, moderates who sought reform were swept away by radicals who demanded revolution. In Russia, the same. In China, in Cuba, in Iran, the pattern is disturbingly familiar. Crisis leads to anger, anger leads to division, division leads to extremism, and extremism leads to systemic change, usually through conflict. We are not immune to that. The United States today is experiencing historically high levels of political polarization. Trust in government, media, and even neighbors is near record lows. The country is split not just ideologically, but geographically, generationally, and culturally. And this matters deeply for markets, because when societies fracture, policymaking becomes erratic, consensus disappears, stimulus and austerity swing wildly. Long-term planning gives way to short-term appeasement, debt rises faster, inflationary pressures intensify. Risk premiums rise not just in markets, but in people's behavior. Productivity suffers too. A divided society is a distracted society. Resources are misallocated not toward innovation or competitiveness, but toward internal battles. Regulation becomes reactive. Business confidence wanes. Investment stalls. The energy of the system is consumed by internal conflict. There's also the question of legitimacy. If a large portion of the population feels the system is rigged, whether rightly or wrongly, they will not play by its rules. That leads to non-compliance, protests, social unrest, and in the extreme, civil conflict. And when the system itself is questioned, markets become unanchored. Because markets don't just price assets, they price stability. This is the internal game. And it's just as important as interest rates or earnings reports. In fact, I would argue it's more foundational. You can't have a functioning economy without trust. You can't have a trusted currency without institutional credibility. And you can't have peace without a shared sense of identity, or at the very least, a mutual respect for the rules of the game. That's why I often say The health of an economy is the health of its people psychologically, emotionally, socially. When people feel productive, included, and hopeful, the system works. When they feel excluded, unheard, and angry, the system destabilizes. Right now, the U.S. is at a crossroads. The debt is high, growth is slowing, inflation is sticky, and the political will to make tough, long-term decisions is weak. Why? Because those decisions are unpopular. And in a polarized environment, popularity is survival. So leaders stall. They kick the can. They promise everything and deliver little. And the cost of that avoidance gets passed on not just in dollars, but in confidence. Confidence in the system, in the future, in each other. So what does this mean for you as an investor? It means being aware of the second order effects. Markets don't just reflect economic data, they reflect human psychology. And when a society loses its center, volatility increases not just in price, but in policy, in trust, in outcomes. This doesn't mean collapse is inevitable, but it does mean that the risks are rising. The internal game, how we relate to each other, how we resolve disputes, how we build consensus, will shape the kind of environment we all have to invest in. Because before empires fall, they fracture from within. And if we're wise, we'll recognize those fractures early, not to fear them, but to understand the part they play in the larger cycle. While internal cohesion determines how long a nation can stand, its place in the world determines how much influence it can wield. And when both begin to erode internally and externally, what follows is often a realignment of the global order. We are witnessing the early stages of such a shift. At the center of this external game is the United States, not just as a country, but as the architect and enforcer of the post-World War II system. Its primary tools of influence were clear: military dominance, economic leadership, and above all, the U.S. dollar is the world's reserve currency. That last one, though often overlooked, is perhaps the most powerful. When your currency is the default medium for global trade, investment, and savings, you gain enormous leverage. You can borrow in your own money, you can sanction adversaries, you can influence global capital flows with the turn of a dial at the Federal Reserve, but as with any advantage, overuse breeds resistance. The U.S. has increasingly weaponized the dollar not just in war, but in diplomacy. Sanctions are now a primary tool of statecraft. They restrict access to capital, freeze foreign reserves, cut off financial systems. In a sense, they are an act of economic war, nonviolent, but deeply impactful. When the U.S. and its allies imposed sweeping sanctions on Russia following its invasion of Ukraine, it wasn't just about punishing aggression. It was about sending a message that if you act against the rules of the current order, you risk being cut off from its privileges. But here's the dilemma. If you threaten the reserve currency's neutrality, you begin to erode the very trust that makes it dominant. Russia, anticipating this, had already begun to de-dollarize its reserves. After the sanctions hit, it pivoted even further, transacting more in yuan, rubles, and other non-dollar currencies. China, watching closely, accelerated its push for the digital renminbi. Other countries, India, Brazil, even traditional U.S. partners started exploring alternatives. Not because they dislike the dollar, but because they no longer trust that it's neutral. That's the quiet crisis. When a country like Saudi Arabia starts discussing pricing oil in non-dollar terms, or when regional trade blocs begin settling accounts in local currencies, it signals not just diversification, it signals a shift in the gravitational center of global finance. And remember, the U.S. derives extraordinary benefits from dollar dominance. It allows persistent deficits, it enables lower borrowing costs, it gives enormous power over global liquidity. If that dominance wanes even slowly, the consequences will be far-reaching. And this is where great power competition becomes more than rhetoric. China, through the Belt and Road Initiative, has established infrastructure and lending relationships across Asia, Africa, and Latin America. It's creating alternative trade routes, alternative financing systems, and ultimately an alternative geopolitical sphere. Russia, though weakened economically, remains a formidable military actor and a natural resources superpower. Its alignment with China represents a strategic axis, a counterweight to U.S.-led influence. Meanwhile, many nations find themselves in the middle, unwilling to choose sides, but increasingly pressured to, just as in past global conflicts, lines are being drawn, though for now, they are economic and diplomatic rather than military. So what does this mean for the dollar? It means the dollar is no longer judged just on the strength of the U.S. economy, but on the perceived fairness and sustainability of the system it represents. It means more countries will diversify reserves, not abruptly, but steadily. It means demand for U.S. debt could decline, and it means the cost of capital for the U.S. may rise over time. If confidence in the dollar as a store of value diminishes, the value of dollar-denominated assets will fall, not necessarily because they are bad investments, but because the measuring stick itself is weakening. This is the essence of a capital war. And like all wars, it accelerates change. It forces decisions that wouldn't be made under normal circumstances. It reveals vulnerabilities that were previously hidden, and it reshapes the incentives of allies, adversaries, and neutrals alike. Right now, the world is asking three pivotal questions. Will Russia win or lose in Ukraine? Not just militarily, but strategically. If it retains territory, maintains influence, and absorbs the economic pain, it may embolden similar moves elsewhere. Will U.S. sanctions prove powerful or porous? If they are effective, the U.S. maintains credibility. If they are circumvented or weakened, it signals to the world that dollar-based leverage is no longer absolute. How are nations choosing sides or choosing neutrality? From United Nations votes to trade alliances to financial flows, we are seeing a sorting, a silent realignment that reveals who believes in the current order and who is preparing for something new. For investors, this external game cannot be ignored. It influences currency risk, energy security, trade routes, inflation dynamics, and ultimately the relative safety of where and how you hold your wealth, because capital, like people, wants to live in safe, stable environments. And in a world of rising tension, safety is becoming more relative. The dollar may still be dominant, but it is no longer uncontested. And that, more than any single policy or price, may be the most important shift of all. If you've followed along this far, you may feel a bit unsettled. That's not a bad thing. Clarity often begins where complacency ends. We're not at the end of the world, but we are near the end of a cycle, a long-term paradigm that shaped everything from asset allocation to policy making, from how people save to how countries borrow. And now that cycle is shifting. That means the game is changing. So what does a thoughtful investor do in this environment? First, stop thinking in nominal terms. Forget the raw numbers in your account. What matters is your buying power, what your money can actually purchase over time. Whether it's $1 million or 10 million, the question is the same. What does it buy in an environment of rising inflation, uncertain policy, and devalued trust? The worst thing to do is hold cash blindly, because in an inflationary environment, cash is not safety, it's erosion, quiet, unseen, but real. It's like holding water in cupped hands while the sun beats down. The longer you hold it, the less you retain. The second danger is unbalanced exposure to debt instruments, especially those with fixed returns in fiat currencies. Bonds, once considered the safe foundation of a portfolio, can become traps in this kind of environment. They're just promises to repay future dollars. And if those dollars are worth less, then the return is illusionary. Let me give you a concrete example. Japan. For decades, Japan ran high levels of debt, but avoided crisis by monetizing it, printing money and buying its own bonds. Bondholders weren't wiped out overnight, but they were slowly drained. Over the span of 30 years, Japanese bonds underperformed dramatically. Measured in dollars, Japanese savers lost about 45% of their wealth. Measured in gold, they lost over 60%. And the average Japanese worker saw their global purchasing power drop by nearly a third. In gold terms, their income went from the equivalent of 13 ounces a month to just one. That's the quiet devastation of monetary debasement. And the lesson is simple. Nominal returns don't protect you if the unit of measure is falling. So what should you hold? You want assets that have intrinsic value, things that can't be printed. That includes productive businesses with pricing power, commodities that are essential, infrastructure that generates real cash flow, technology that solves urgent problems, intellectual property that creates scalable value. And yes, to some degree, stores of value like gold or possibly digital assets, depending on their durability and network trust. But diversification is not just about asset classes, it's about jurisdictions. If power is fragmenting globally and trust in single systems is weakening, then it makes sense to diversify across geographies and political regimes. That doesn't mean abandon your home market, but it does mean don't be entirely dependent on one monetary, legal, or political framework. Because systems, like currencies, are only as strong as the confidence that upholds them. Next, stress test your assumption. Ask, what if inflation is 5% for the next 5 years? What if real yields stay negative? What if U.S. debt loses its appeal to foreign investors? What if policy becomes more reactive, less coordinated? Those aren't predictions. They're possibilities. And resilient portfolios are built not on certainty, but on preparation. This isn't just about investing. It's about seeing reality clearly and aligning your decisions with it. It's what I call living in harmony with the machine, understanding how the economic engine works and positioning yourself accordingly. And perhaps most importantly, cultivate adaptability. We are moving into a world where yesterday's truths no longer hold, where mental models built on low inflation, low volatility, and high trust in institutions need to be re-examined. That requires humility, curiosity, and a willingness to unlearn. Because what's coming next isn't just a shift in prices, it's a shift in psychology, in incentives, in how we think about safety, value, and wealth itself. Cycles don't end, they evolve. And those who see the signals early, those who study the patterns and prepare, not only survive the shift, they can thrive in it. So the real question isn't just where is the market going, but rather how are you positioned, not just financially, but mentally for the world that's emerging? Because as always, the world is changing. And those who adapt with clarity, discipline, and principle are the ones who will shape what comes next.